Okay. So before we start class with the discussion on chapter 4 of the framework, I'd like to answer first the question raised by one of you by some of your classmates. One of your classmates class asked if will the prices of goods recorded in financial statements with its fair value also change every time the fair value of that good changes in the market periodically? If so, how should that change in value be recorded? Okay, this is an excellent understanding of the requirement when you are going to use the fair value model or the fair value measurement for your uh, assets and your liabilities. It's correct, class, that fair value is a type of measurement that is very volatile, is expected to change day in and day out. If we're talking about fast moving goods, class, we expect that the fair value, the value of these uh, items to change even daily, class. So if we use the fair value model, the rule is supposed to be to adjust the carrying amount, to adjust the value of our assets and liabilities to match it with its fair value. So if the fair value changes, class, then you will also have to change the recorded amount of our asset and liability. So if the fair value changes every day, class, then you are expected supposedly to uh, change the amount, the reported amount of our assets and liabilities every day. That's the expectation. That's the strict compliance or the strict application of the fair value measurement class. Okay. But I'd also like you to recall that in the preparation of financial statements class, we have to do the cost benefit analysis class. We have to take into account the cost constraint. Expectedly, if we are going to regularly adjust our records class every day, every time that the fair value changes class, then that would be very time consuming, that would be very burdensome, and it will reach a point class that the value that we would get from regularly changing or updating our valuation class would no longer be worth it, would no longer be enough to compensate for the burden that is imposed on us. So what I am saying, class, although the rule is supposed to be to regularly change the fair value, we need not do it, class, due to considerations of convenience, due to consideration of practicality, class. Even though the rule tells us to update, to adjust the valuations so that it would be reported at its ever-changing fair value, but for practical reasons, class, for reasons of convenience, we do not do it every day. If you'll also recall, class, our financial statements will either report for a particular period, for events that happen between the start of the reporting period and at the end of the reporting period. We also have financial statements, class, say for example your statement of financial position or your balance sheet, which provides you with information on a particular date, which is our reporting date. If we use the calendar year, that will normally be December 31. Our balance sheet date, class, our statement of financial position will be dated as of the end of the reporting period. So if you are reading the statement of financial position, class, your thinking would be that the amounts here, the information that I will see here, pertain to the position of the business as of the end of the year, as of the reporting date. Okay? Whereas, for example, in your income statement, it tells me of the events that happened from the start of the year until the end of the year. Now, why am I bringing this up? Because in the use of the fair value model, class, if we measure assets and liabilities at fair value, if we are preparing our statement of financial position or our balance sheet, then the most relevant fair value figure here, class, would just be on December 31. What is our goal for our balance sheet? It would be to provide our position. So we must show our assets, liabilities, and equity. But what valuation are we going to present for our assets, liabilities, and equity in our balance sheet? In our balance sheet, it would be their carrying amounts as of the reporting date, as of the balance sheet date, which is normally the end of the year, which is normally December 31. So my point, class, is in the presentation of our assets and liabilities class, yes, we are supposed to keep on changing it every day, class, every time there's a change in the fair value. Okay, but practically speaking, we don't have to do it because in our balance sheet class, the only information that is needed is its value as of December 31. So for example, the fair value on January 1 was 100,000. Okay? And it changed to 101,000 on January 2. On January 3, it's now 99,000. On January 4, back to 100,000. On January 5, 103,000. On January 6, 98,000. Okay? By strictly following the fair value rule, class, we're supposed to do it every day. But ultimately, if our goal is to simply report this asset as of December 31, we just have to determine the fair value on December 31. Now you would ask, but would that not cause any problem in all the other parts of the uh, financial statements? The answer is no. Because one reason, class, that we are supposed to monitor the changes in the fair value so that we can recognize, so that we can report as a gain or a loss, the fluctuations in the fair value of our asset or liability. If we're talking about an asset, then if the fair value increases, then that will be considered as a gain on our part. If the fair value decreases, then that would be considered as a loss on our part. Because let's say, for example, we purchase it at 100,000, but if its fair value goes down, then we suffer a loss based on the amount of decrease in the value of the asset. Okay, but if you are going to report for your total gain or loss, class, for the entire period, for the entire year, you could get the net amount, you could get the total amount, class, by simply comparing the fair value on January 1 and the fair value on December 31. I hope you're able to follow my point, class. Okay. January 1, 100,000. January 2, 99,000. January 3, 101,000. And that has been the pattern, class, throughout the entire year. It will be 101,000, go down to 99,000, go up to 101,000, go down to 99,000. Every day that happens. Okay? So on January 1, we will have a loss of 1,000. Sorry. On January 2, we'll have a loss of 1,000. And then we'll have a gain of 2,000 in uh, January 3, from 99 to 101, there will be a gain of 2,000. Then on January 4, another loss of 2,000. Okay, from 101,000, it goes back down to 99. On January 4, when it goes back up to 101,000, then another gain of 2,000. Okay, ultimately, the losses would offset with the gains, class. That ultimately, the total gain or loss for the entire year, class, would just be the same as the difference between the fair value and the fair value on January 1 and the fair value on December 31. If our goal is to be able to report the net change in the value of our asset throughout the entire year, then you can achieve that by simply comparing the January 1 and the December 31. If your goal is to report the value of the asset as of the balance sheet date, then the only value that you need is December 31. You do not need the September 23 fair value. You do not need the August 1 fair value. You do not need the May 10 fair value. If our objective is to give the value of this asset as of the balance sheet date, if our goal is to simply report the net or the total amount of gain or loss throughout the entire year, we do not have to monitor it every day, class, if our goal is just to get the net change in the value for the entire year. But again, if we are to strictly follow the rules, class, we're supposed to do that. We're supposed to do the adjustments every day. But again, it's not practical when in the first place we can achieve the objective of our financial statements by simply comparing January 1 and December 31. But no one will stop you, class, if you do that, but nobody does that because that is not practical. Okay? And besides, there's another way of achieving the goal of preparing our financial statements without having to make adjustments day in and day out.